So thanks for coming to ElderAdo Financial. We do this twice a year, one in January and the other one either September or October. And here's a disclaimer. Basically, this is for educational purposes, so don't sue us for anything I say today. And we're going to talk about what's new at ElderAdo Financial. We have all kinds of new things that have happened. We've been going pretty steady for a long time, and then we've had some changes that's happened here recently. First thing, just to share with you, this is our company when we started back in 1990. Whoops, oh, what did I do? I did something wrong here. Back in 1998, and it's grown up. We are managing now $94 million as of today. We're able to do that because of technology. With a small firm like ours, we had 3 of us in the office last year, and then more recently Jamie and Daniel joined us, so now we have 5. We're able to manage that because technology has really helped us be very efficient on trading, rebalancing, research, and all that type of stuff. So we're able to provide you better service with the new changes that have happened. The other thing that we'll let you know too is our minimum has been $100,000, but with technology, we're able to take in smaller clients. So our minimum will be $25,000 to join our firm because we can handle smaller firms. So if you know people that don't quite have $100,000 and can't be a client of ours, and that's our little mascot back there making some noise. So let us know if you have somebody that wants to join a firm, and $25,000 is our now new minimum because we can handle smaller clients. This is our new members, Jamie and Daniel. Jamie worked at Schwab. Wave, that's her. She worked at Schwab for 6 years. I'm sorry, I say that backwards. She worked at Vanguard for 6 years. Went to school and for business and finance, and then gets a job in the same industry as we did. And then when it came opportunity for her to join the firm, we offered her to come on down. And so she has all kinds of experience with management and just this whole field. And then Daniel has worked at Schwab, and he's been on the trading desk and knows all about options trading and all kinds of things that I don't even understand. So, so great to bring that experience here into our office. The other thing is you received a letter from us about a merger that's going to be happening between Charles Schwab and TD Ameritrade. We've been with TD Ameritrade for a long time. We started back in 1998 with a company called Jack White, and then shortly after that, Jack sold his firm. Basically, Jack White and Charles Schwab started the discount broker business, and we chose Jack White because we were a small firm, and I didn't want a big firm like Charles Schwab, so we worked with Jack White. Well, then shortly after that, he sold to Larry Waterhouse, so we were Waterhouse, and then Waterhouse merged with TD Ameritrade. TD is Toronto Dominion Bank in Canada, Canadian bank, and then TD Waterhouse sold to TD Ameritrade. And so we've been with Ameritrade for, I bet about 15 years or so. And then just recently, Charles Schwab has decided to buy out Ameritrade. Basically, we've loved Ameritrade because it's like the old commercial Avis, we try harder. Well, Schwab was always the big boy, and Ameritrade could never catch up to them. But Schwab could never put Ameritrade out of business because they were so good. They worked really hard. And we liked it because we were a small firm, and we still are a small firm. Just bear with me for a second. Sorry, we don't need any more heat in this room. All my hot air comes from here. So we just liked working with them, and they were smaller. Well, now what's happened is Ameritrade has so many great tools for us advisors that Schwab has always been trying to catch up, and it's just easier for them to just merge the firms together. And we'll talk about that here. So we don't know if the name's going to be AmeriSchwab, laugh, or Schwab Trade. So we don't know which one. No, they probably won't. It'll just probably be called Charles Schwab, probably. So when you look at this here in the fiduciary world, which is our world, Schwab and Ameritrade are the 2 biggest firms. Fidelity is a big firm, but they don't have that many fiduciary advisors. And then there's Pershing and E-Trade and some other smaller firms. So in the fiduciary world, those are the two big boys. But then when you look at the whole scheme of things, merging these two companies, Schwab and Ameritrade, puts them into line with Fidelity, Vanguard, Morgan Stanley, Bank of America, and Morgan Stanley, and so on. And so what they're trying to do is bring in value, large numbers, so where they can be competitive. And so that's where we're at. So people are asking, what's going to happen? First of all, the deal won't even be, if this completes, we all read the news and so on, the deal won't even be signed till sometime this summer. Okay, and I've been through 4 of these. Generally, nothing really happens for about a year after that. I mean, it takes a long time. They're not going to just, unless I'm totally wrong, but I don't think they're just going to say everything's going to change. So we will keep you informed on what's going to happen. And if this does not turn out best for you, the client, because we're fiduciaries, we'll be shopping and we'll be talking. We're already getting calls from other companies like Fidelity saying, hey, move your clients. We're not moving anything until we see what this package deal is. And I really think that this will be a good deal for everybody. Because Schwab is not going to spend $26 billion and blow that money. They're not going to throw it away. So they're going to use the great tools that Ameritrade has, and I think they can merge they're going to merge the best of both worlds, and I think we're going to have some great tools, some great features in your accounts, even better than what we currently have. So let's just hold tight. Let's see what happens, and we'll be right there working with you and keeping you informed on it. Okay? If you have questions, let me know. And this is just showing how Schwab has 20,000 employees, and Ameritrade has 10, and so on. They have 12 million clients, and they have 12 million clients. The biggest thing here is Schwab always has the bigger clients, and that's why we chose Ameritrade, because we started off with small clients. And seriously, even in Montrose, if you have $1 million in the whole scheme of things in the fiduciary world, you go to Chicago and New York and Miami and all these other big cities, $1 million account isn't that big. There's many financial advisors that have $5 million minimums or $10 million minimums. For us, taking smaller clients in a small town is very unusual. But we love it because I love the quality of life here in Montrose. I love the people, and I'd much rather be here than in Denver, because if I stayed in Denver, we could have had a $500 million firm with all kinds of employees and running the rat race, and I didn't want that. I wanted a quality of life. And same with Jamie and Daniel. They were in Phoenix and driving in rush hour traffic. She'd call on her way home at 7 o'clock or 8 o'clock at night after working all day, talk to us on the phone while she sits in rush hour traffic. And after a while you get kind of tired of all that. Okay, the other new thing is what happened right before all the merger was Charles Schwab came out and announced that there's no cost to buy a stock or ETF. And then within an hour or so, Ameritrade said no cost to buy a stock, and then everybody down the line, a couple days later, Fidelity and all the other companies said we're going to do the same thing. So now most of the major firms, there's no cost. Why is this big news? Because they were charging $7 per trade. That's not that much. The big reason why it's so neat is now when we rebalance, and we're going to be talking about that soon, when we rebalance your portfolio, we buy and sell investments to get you back in line. We'll talk about that shortly. That now we can do that with no cost. Before we only had 550 ETFs in our portfolio available. Now we have all of them, which is over 3,000. So we can get every single ETF, and we can choose the best of the best of the best, which is what we do for our clients. And now that all of them, there's no cost, that helps us rebalance. So when Janet goes to rebalance and needs to change, it gives us freedom to be able to rebalance our portfolios. Okay, what happened in 2019 also in news, not just with our firm, is the Secure Act. The Secure Act was passed right after the impeachment, right before Christmas, and they hurried up and passed it. And what it is, I forgot what the acronyms, they always have acronyms. It stands for, oh, I forgot. But basically, future retirement. Yes, that's all kinds of things. We'll talk about that. Yeah. So now, the RMDs, now if you're already taking an RMD, this doesn't help. You have to stay on yours. But for those new people that turn 70 and a half, starting January 1st, don't have to take an RMD now until 72. Now, if you're already taking them, that doesn't help you. But for all these others, why are they doing that? Because we're all generally living older, and they're giving us more grace. A lot of people have been complaining they have to take money out at 70 and a half, and they'd rather wait. So now, for younger folks that are not that are not 70 and a half, can wait now till 72. You can contribute. Oh, you can also contribute to your IRA past 70 and a half. Before you couldn't, and now you can contribute if you have earned income. Okay, and if you're in a 401k with a small employer, they have auto enrollments. You get businesses, if you have a small business, you get a tax credit for starting a 401k. And I see some of you taking notes. Yeah, there's the notepads there. Write some notes down. And there's an evaluation too. So on there, if you have questions, write those down, because Shannon will pick those up afterward. And so if you want to talk to me, or Jamie or Daniel or Janet or Shannon, then write it down and we'll schedule an appointment to come in and talk to you, or talk to you on the phone. And then this is the other big news, is removal of the stretch IRA. When you inherit an IRA, you can stretch that over your lifetime. And now that has changed, that it has to be paid out within 10 years. So it doesn't affect a large number of people, but it does affect a lot of people in this room here. So those are new rules that we'll be helping you with. Okay, next thing is what happened in 2019. So this was a third presidential year for Donald Trump. The first couple of years generally are the honeymoon. New president comes in, doesn't matter who it is, Republican, Democrat, that it's in the honeymoon phase. All kinds of things are happening. The stock market does okay, but it's not very certain. By the third year, you can certainly see what his policies or her policies are when they're president. And generally, then things are pretty calm, and generally the stock market does well. And what happened last year? It did very well. So last year was very typical for a third presidential year. Strong economy, very strong economy that we have. You hear all the numbers, and we'll go through that here soon. Impeachment process. This is the third person to start the procedures in 9 presidents. Right? We've had Nixon, Clinton, and Trump. So we've had 3 out of 9 last presidents go through the impeachment process. Nixon resigned before they got too far into it, but they did start the process. Trade wars, you've heard all that going on with Canada, Japan, Mexico, and then the big one is China, and they're working on that and trying to improve the trade balances. Geopolitical, oh boy, there's all kinds of stuff going on. North Korea, Venezuela, Iran, all kinds of things like that. And that just never ends. And finally, the stock market. And so let's talk about that here. The geopolitical events. So you can just see all the things that's going on. And, Mr. or whatever, with the nice haircut that he has there. And just things going on. And it just always keeps things in turmoil. So, is this good or bad to have all this stuff happening? It's actually very good for the stock market. The worst thing you really want for the stock market, everybody thinks it's going to go down, is when everybody's happy, there's no bad news, and everybody's throwing money into the stock market, and it just goes up too fast. So news like this is good, because then when there's stuff going on in Iran, it slows, and even though it's growing, but it's keeping everything in check. And so they're, it's able to keep the market moving along, but it's keeping everything in check. Okay, so let's talk about the economy real quick. Low unemployment is basically the lowest in all our lives, 3.5%. When I remember when I went to college in the 70s, we had a professor said the lowest our unemployment will ever get is 5%. That's what he said, because that was basically full employment, 5%. We're at 3.5%. And we have 7 million jobs that need to be filled. We have the candy factory here in town, and I'm hearing from numerous employers, they're already starting to interview a lot of people. They're going to be pulling people out because they need employees. So I don't think it's going to be too hard. I'm sure there's going to be some people left out, but there's going to be a lot of workers that are going to be hired. Low inflation, so we don't have to worry too much about high inflation right now. This is the CPI number, but we don't have runaway inflation or anything like that going on. Corporate earnings, corporate profits really taking off, and that's what's fueling the economy, fueling the stock market. Trade is improving too. They're meeting with China. China's finally come to the table, but countries like Japan fought it too for a while. Same with Canada and Trudeau. They didn't like it either, but they finally have come to the table because if they want to trade with the United States, they have to make it at least equal. We're not trying to be more fair, but we're just trying to equal the playing field here. Strong GDP going on, and then strong housing. We saw areas like Denver that's taking off. They're softening, but it's still growing. But housing is still very strong, and a strong indicator for a good economy. Okay. Also, when we talk about the markets, we're up. All the asset classes, have been up, which is unusual. Real estate, stocks, gold, even gold. Usually gold doesn't do well when the stocks go up, but everything goes up very well in this year. So we have an unusual year where everything is going upward. Okay? And so that shows that. And here's historical from 1990 to last year. This is the stock market, S&P 500. The green is what it did. And so it was 29.2. Back in 2013, it was 29.6. So it's not really a totally unusual year. It's a strong year, but we've had many years up in the 20s. And looking at that, and this is the 2008 market crash there. So we've had some really good years. But now you look at it and go, well, it's up so high. Well, okay, let's look at this. In 2018, it was down 6%, up 29% here, average about 25%. You take those 2 years and average it out, it's only a 12.5% return we've earned average over the last 2 years. So I'm really not so sure that the stock market is overpriced. It's hitting new highs, but that's what the stock market does all the time. I mean, it's at... what's it at, Daniel? 20? I forget what the Dow is. How much is the Dow?
Dow's over 29,000. The Nasdaq's over 29,000 for the Dow, 9,000 for the Nasdaq, and then the S&P's over about 3,200. If I remember correctly.
So 29,000. When I started the business, it was like Dow was like 850. So how many all-time highs have I lived through? I can't count them. Thousands and thousands. So just keep that in mind that it was a good year. We'll talk about what to expect later in 2020. So we're going to talk about analyst predictions. I don't make predictions, but I wanted to just kind of give you an idea of some predictions that we think could be closer to reality. Let's put it that way. Okay, I try to be very, very careful. So one of the things is that the world has been struggling as the United States has been just barreling along. Last year we were just moving along, and all these other countries have been struggling. And so we have a little bit, we might be slowing down a little bit, but the world avoids a recession, most likely. So we'll be generally okay. China is slowing, it's only at 6% growth, if those are numbers you want to believe. Stock markets return single digits. Probably don't expect a 29% rate of return again, okay? So probably, 5, 10, I don't know, something like that, or 5 to 9, single digits. Foreign stocks will probably outpace the United States. We've been beating the foreign stock markets for a long time, and generally there's various cycles, so probably some of the foreign stocks will be beating the U.S. stocks now. So we'll be watching for that trend. And value stocks will outperform growth stocks. And that's good because as this room here has more gray hair than normal, that we try to go more value than growth. Okay? And solid companies that you're looking for as opposed to, the more high-tech companies. And then active funds perform index funds. This is just an interesting prediction, but index funds have been doing very well for a long time. That's where nobody's managing it. They just buy a basket of stocks and just leave it there, basket of investments. And active is where they think that they can beat the markets. And we've been very good on that, but overall the index funds have done better, but this prediction is that the active funds will outperform. And what we do in our portfolios, we have some active and some index. So we hedge our bets with our clients' portfolios. And then status quo election. Predictions are Trump will win again, and Republicans will hold the Senate, and Democrats will hold the House. So we'll see how that works. Hasn't worked so well lately, but generally, gridlock, stock market really generally likes gridlock. Okay, let's talk about investing here. Retirement income challenge. So there's 3 challenges that you're facing with retirement. And we're going to go through some of this here. The first challenge you have is you need to produce the income you need to live on. Right? That's an obvious challenge. The second one is you need to sustain your income as long as you live. We're having a lot of folks that are living longer and longer and longer. And we'll talk about that here soon. But longevity in this demographic is pretty significant. And then make sure your income keeps pace with inflation. So those are the 3 challenges you have to keep up with, or be aware of. So income. So if you want to invest for income, where do people put their money? They put it in banks, money markets, treasury bills, tips, savings bonds, and fixed annuities. These are income-producing investments that people like to put their money into. The problem is inflation and longevity. These investments don't keep up with inflation, and they don't help you in longevity. People, again, in this room here, you can live quite a bit longer than your parents, and so on. You can live well into your 90s. So we need to make sure your money lasts a long time. And parking money in these investments here are good for certain purposes, for emergencies and so on, but for long-term investing, it's not a great place to be putting your money. Okay, so talk about banks. How much money do you think we have here in Montrose and in banks? 100 million? We have $800 million in banks. Wells Fargo, here in this is just Montrose. They have two offices, $229,000, or $229 million. Alpine Bank of Colorado and so on. $800 million in banks. That's a lot of money that's parked there. Getting what interest rates? Now I can understand, I know companies, when I was on the DMEA board, they have to keep a couple $1 million in the city and the county and so on. They have some, but that's not $800 million. And there's a lot of folks that are afraid about investing, and so their money is just parked in a bank. And so that's a large number. And so let's look here on income investments. The problem with income investments is the income is low, the income is eroded by taxes, and it does not keep up with inflation. So what do we need to do here? Is we're going to talk about taxes and inflation with your investments in a bank. So you have money, and I'm going to say you have $100,000, and I'm going to be very generous. You can get a 1.5% interest rate. And then that money gets eaten up by taxes. When you invest in a bank, you don't get the benefit of capital gains. You pay ordinary taxes. So whatever your tax rate is, you have to pay that rate. And you have 5% state and 28% federal on the average. So that gets eaten up by a third, so now you're getting a net return of 1%. And then you have inflation, and I'm going to say it has averaged for the last 25 years is 3% as our inflation rate. So you have a real return of negative 2%. Not a very good investment. You say, well, my account's growing, but you don't see what happens when you pay taxes every year. You get your 1099 INT, and then you have your inflation, you're losing 2% year after year after year. And you multiply that, let's say you keep it in a bank for 20 years. What happens? That 100,000 now is only worth 60,000 in buying power. Yes, you can have 100,000 in the bank. You don't see it go down. But what you don't see is what does it buy 20 years later. Okay? And what we call that is going broke safely. That's what happens. People, my money's safe, right? Not the wisest thing to do. Let's talk about inflation. So we're going to go back and look at what inflation has been. And the best chart I could find was 1975 to 2015. I was trying to find one for this year, and I didn't have a large amount of time, so I just used these numbers. So like a house back in 75 cost about $46,000, and a car was $3,800, and you can see how they've gone up in value, and that's just inflation. And so what will happen is just it eats at you, right? Day after day after day, things go up little by little by little. And so now I want to show is what happens in the next 30 years. We go forward to 2045. A house would cost average $750,000. A car would be $151,000. Minimum wage would be $31 an hour. I mean, I started at $1.08. Whoops. What did I do here? I started at $1.80 an hour at Dairy Queen in Villa Italia Mall in Denver, and so I thought I was getting rich. I mean, $1.80 got you a lot of money. I was the ladies liked me. Guy with lots of money. So we're going to talk about investment strategies. So there's a three-step process. The first one is diversification. So you don't put all your eggs in one basket. And you say, I'm afraid of the stock market. Well, the stock market has all kinds of subcategories in there. There's large companies, medium companies, small companies. There's value companies, there's growth companies, there's blend, there's U.S. companies, there's foreign, all kinds. So you have different sectors and subsectors in there. And then we have bonds. We have government bonds. We have foreign bonds. We have corporate bonds. We have treasuries. We have treasury bills, notes, and bonds. We have high-yield bonds. We have bank notes and all kinds of things. So what you do is you don't put your eggs in one basket. So people just worry, I'm going to lose it all. So let's talk about the stock market. Stock market is risky, right? Everybody says that. And it is. If you take your money and put it in the stock market for 1 year, what are your odds of losing that money? If you sold it, let's say you put it in and you say, I'll sell it in a year. Your odds are 1/3 that you'll lose that money. That's a pretty high odd. But who ever invests in 1 year? For 1 year. You shouldn't. If you come to me and you say, I'm going to buy a house in 1 year, that darn well better be in a treasury bill or some other safer bond because you're going to need it in 1 year. So you look at the stock market. This is 1 year. Look how many greens, but there's a lot of red in here. But if you look at a longer time period, like a 5-year time period, then you'll start to see a lot more greens because you're averaging out the 5, and the reds diminish. You have the Depression, 1929, and the 70s, and what's happened here. And then if you look at 10 years, the red, the down years hardly are at all, and over 20 years there is none. There's no 15-year time period that you've ever lost money in the stock market. So if you keep it in for a longer period of time, then it's not risky. And this just shows you, here's what an average 1 year return of the markets, here's average 3-year, average 5-year, 10, and there's never been a period over 15. So you don't invest in 1 year, and if you start investing with us tomorrow and the market goes down, we say, here's some whiskey, and go home, and don't worry about it. You know? I mean, you know, they're watching their statements, and I can see it. I can see when you guys log on to your account. I can't see what you see, but I see your logins. And I just kind of look at that periodically and see, and I can see some of you in this room that log in every day. It's like, some of you twice a day. It's like, okay, you know, if you want to do that, that's fine. It would just drive me crazy. I've stopped doing that a long time ago because I have faith in the system that we have. And so, you know, staying invested for this time period is a very safe investment compared to others. So let's do this. Let's say you come to me and you say, well, Jim, I'm just not ready to take on all this risk. So I'm going to take $100,000 and invest it for 25 years. And average has been about 0.6%. And that money, the $100,000 over 25 years would have grown to 116. And then I tell you, let's do this. Instead, take your money and break it into 5 parts and take 20% in each, and let's invest it. So you ready to invest? So we're going to start a portfolio here on the right side of this yellow line. The first money we're going to invest in is lottery tickets. You ready? 20,000 into lottery tickets over 25 years, and you take those winnings that you happen to get and you go buy more lottery tickets, and after you go a couple times, you're out of what? Money. So you will have lost all that money. So 1/5 of your money invested in lottery tickets, you lost every penny. The second 20%, we're going to take that money and bury it in your backyard. And you guys laugh. I know some of you folks, and we talked to other professionals, mainly attorneys and CPAs, that you folks have shared with us that you have money buried in your property. There's all kinds of money buried. And so when people reveal that, I said, who else knows? And I said, nobody. I said, okay, when you die, I'm buying your house and I'm getting back. So seriously, if you have money buried, let somebody know. Okay, we've had people write on an envelope, seal it, put it, and bring it to us. We put it in the safe in the back, and when you pass away, we hand it to whoever you want it to see it. Because otherwise, anybody that happens to know will be digging up that money. So you take that money and you bury it for 25 years, and it's 20,000. The third section of money we're going to invest in this portfolio will be a bank CD, just like this one. So 0.6, that 20,000, because that's 100, 20,000 will be 23. The fourth place we're going to invest in is the safest investment you can find. What is the safest investment in the world? Treasury bills. United States Treasury bills, safest investment. Backed by the full faith promise of the United States government. Isn't that crazy? And what's going on in Washington these days? You have that much faith. Anyway, so that's a Treasury bill. And then the fifth one, we're going to take that money and really go crazy, and we're going to buy stocks. And we're going to just buy the S&P 500 index. And over 25 years, ups and downs that it's gone through, it grew that. So now, what happens when we take all 5 of these, 1/5, 1/5, 1/5, 1/5, and 1/5? What happens with this portfolio when we add them all together? It grew to $213,000. So here, you take that money, you throw away. The second money, you bury it, gets no growth. Third one, you do the same as this one, just invest in the CD. Fourth one, you buy a treasury bill. And then the fifth one, you risk, if you call that risk, your money in the stock market. You will have doubled your money by taking a balanced approach. And what kind of risk did you actually take? You took far more risk over here buying lottery tickets. Okay, so let's talk about asset classes. There's 16 asset sectors that we can look at. And in a year, let's say this is year 2006, we say this is what the investments are going to do this year. And you say, Jim, I want you to buy this one and this one and this one. These top 3, right? Because that's what that did the best. But what's going to happen in 2007 and 2008 and 2009 and so on? What's going to happen? You don't know. So how do you know what to invest in? Do you just take the best one here? Is that always the best? Is that the wisest strategy? what you want to do is diversify. And when you look at a chart, a 10-year chart, and all these different sectors, they have the top performing. When you look at this, do you see the pattern? Do you see a pattern in here? If you see a pattern, I have a psychiatrist for you. Because you can't figure this out. Up here, the real estates were the best performer. Next year, what? Worst. Okay? Or next year, in 2007, emerging markets best, worst, best. You can't predict what's going to be there, and people want to try to time the markets and say, this is the best, this is the best, this is the best. You can't predict that, and you can't pick the top performing. So what we try to do is diversify, okay? So, people say, well, I want the best performing investment. Well, don't we all, right? But why pick just a few instead? Like if you go to a horse race, why pick on just one horse? Why don't you bet on all the horses? Instead, why do that? Why don't you just buy the horse track, right? And that's what we're doing. We're buying the horse track. We own the horses and everything generally moves upward. We can adjust portfolios during different times, but people try to pick and beat the markets. It's very, very difficult to do. Okay, next. And so if you pick these top three here, then and you can know, then let me know, because we can get you a job in Wall Street and make a lot of money. I had a young doctor a long time ago. He says, well, before he became a client, now you're going to call me before the markets go down. And I looked at him, I said, if I could do that, would I even waste my time calling you? So anyway. Okay, so you look at all the markets, and what happens if you just missed one of the top three? If you missed the top three. So that last chart you saw, all those sectors averaged 7% for the last 10 years. It's averaged 7%, all if you just buy them all. But what if you tried to pick the best, but you missed it, and you missed the top three each year? If you missed the top three each year, you would have only gotten 1.9%. So you can't predict what's going to go. So what you do is you buy them all. You buy all the horses and bet on them. Okay, we're going to talk about the second part here is long-term focus. You need to have a long-term approach. It's very difficult in 2008, wasn't it? When it's going down and you're seeing portfolio and you're going, well, my retirement's ruined and now I can't, all my dreams are gone, and people get so short-term focused. What we need to do is stay long-term. Look what happened in 2008. This is, whoops, I did that again. Hang on. Sorry. I did, right? Hang on. Okay. So this is stock market, and it fell in 2008. And at the bottom, March 9th of 2009, we had three investors. One investor just pulled his money out and parked it in cash. It never grew anywhere. This next investor, the dark blue one, he waited 1 year. Waited 1 year and said, okay, I think we're past that market crash. And so then he invests. And it gets $155. And then the other one, the light blue, stayed in the market, didn't try to time it, and that $238,000. So that is an $80,000 mistake this person made. This is almost a $200,000 mistake this person made. Staying in the market, stay invested. We can adjust. I'm not saying ride the train down, but don't try to time it, because that's what happens when you try to get out of the market and you know darn well it's going to keep going down. Well, how do you know? If you knew that, then the old adage, if investing were easy, we'd all be rich. And that's so true. Okay, we're going to look at different layers in your portfolio. So when you have your portfolio, we've done this before, some of you, but there's cash and different bonds and real estate and stocks and so on. You have your portfolio. Remember, the safer ones are down here, bank CDs and so on, and metals and bonds and real estate, and then stocks up in here. And so you have your diversified portfolio that's stratified. And so what we're going to do is look at your retirement. So when you retire right now, and then this is what money you're going to need to live on. This is called inflation. You retire and you need $5,000 a month to live on today. What are you going to need to live on later on? 8, 10, 20,000? Who knows? I can't believe it. I mean, when I was a kid, I don't know how old, I was probably maybe 8 or 9. My dad was president of this company, had 40 warehouses, and he was president of this company and one of the wealthiest people in town. And I heard him tell somebody that he made $20,000. And that was back in 1965 or something. That was a lot of money. And so when I went to college, I thought, if I can make what my dad made, that'd be great. And I'm seeing these guys graduating before me, and they said, man, that sucks. I said, why? He goes, well, I got a job. Well, how much you making? He says, $20,000. You can't make a living off of that? Well, you know, it's called inflation. So what I thought was a lot of money back in the 60s isn't as much in the 70s, and certainly not now. And so that's what the money you're going to need. And so when you are in retirement, then you're going to need some money in sources. So what we'll do is get you a bucket of money here. The first bucket for the first couple of years, and the second bucket for 5 to 10 years, and 10 to 15, and 15 to 20, and 25. And so you have different buckets of money. Okay, so you're going to have some money here and here. So which money on that pyramid do you want right here? What you want to do is take that pyramid and lay it sideways here. So you have your safe investments, cash coming out of here. And then you have your metals and real estate and bonds here. And then out in here are stocks. So you don't have to touch that money because you're supposed to buy low and sell high. And so you shouldn't be selling stocks unless they have been, once they've been very high right now. We have been readjusting, and we'll talk about rebalancing very shortly, but we've been rebalancing and moving some of the stocks out. But this way here, you have your safe investments for the next several years and so on and so on. So you don't have to worry about it. So if we have a correction, stock market crashes, and where did all my money go? Well, leave that kind of alone. It'll bounce through and live off of this, and these can recover, and we'll get back through it again. But if you're running out there and selling this during a market crash, then you'd be like those people that lost those other gains. Okay, this is how, and this is how we do it here. The third part is rebalancing. I'll just share with you briefly. This is Janet's job mostly. She does the rebalancing. And so rebalancing is we start off with a portfolio, whatever allocation, you might be high risk and low risk, and you have a pie chart. And you start off like this, period 1 here. Let's say, for example, you have 4 areas, 25% each. Over a period of time, the green grows a little bit and the yellow grows a lot. And even further, period 3, green grows even more and the yellow grows even more. What happened? This portfolio is not the same as that portfolio. This might be a moderate, and now this might be an aggressive portfolio. We got to bring you back to that. And so what do? We rebalance it to this. What happens when you move from here down to here? You're selling what? The green and buying some blue and red. And we're selling some of the yellow and buying some blue and red. What did we just do? We sold high and we bought low. People always ask me, you guys ask me, what's the secret of success? You buy low and sell high. So, selling high and buying low, it's the same thing. So we're buying, and you go, well, that's crazy. Why do we want to? It's already up so high. No, you're taking the profits and moving it back and buying something else lower. By doing that, that can help you by 1 to 2% performance by doing that over a period of time, keeping you in balance and taking the winners and selling those and buying some of the others that are not as strong, because then later on it might be the blue and red that are bigger than the green and yellow. Okay, let's keep on going on here. So, we're getting here. So we're talking about, the final thing I want to talk about is investing. And there's all the different sectors we talked about. You know, you have energy, you have utilities, you have automobiles, durable goods, healthcare, all different places to invest money. And we get it this year, or last year, we've had a lot of calls and a lot of people coming in to talk about what? Hemp and marijuana. They all want to invest in that. And So we have bought some for those people that wanted some, and the results are not the best. But and I'm not saying it's bad, but it was just a little risky. So let's talk about, this is a technology. This is what's happening in this world today. We're generally older, and so we are dealing with all the technological changes that's going on. And we need to, as our firm, stay on top of it so we can find places that we can invest for you, the client, and get your portfolios to grow. Because this is where a lot of the money will be made over the years. And so there's just so many things going on. I don't know if you've been reading and watching and hearing about it, but I'm sure you have because it's all in the news. And this is just an example here talking about the integrated circuit. Started off with relays and transistors. Remember, well, we had vacuum tubes. Anybody remember the old vacuum tubes? I even saved some, but I don't have them anymore. But they were pretty cool looking, And it's like, wow. And that big vacuum tube then was replaced by a little transistor. And now that little transistor now is replaced by an integrated circuit. How many transistors are on a computer chip these days? 30 billion. Something smaller than a pencil eraser. 30 billion transistors. I can't even imagine 10,000 on that little tiny thing. It's just amazing that they are so tiny, and that's called exponential technology. That growth keeps growing faster. You've ever heard of Moore's Law? Anybody heard of Moore's Law? That's where technology doubles every 18 months. And when he came up with that long time ago, he's been pretty accurate. We've been doubling our technology every 18 months. Just looking at things, the cars we drive, and things we're dealing with, the technologies, it's changing. Medicines. People were dying of all kinds of diseases that now it's kind of a nuisance more than anything else. People aren't dying of colon cancer, breast cancer, prostate cancer is frequent. And if you are, you're probably not going in for testing, because if they find it early, it's not a problem. I used to sell life insurance a long time ago, and even back then they said, well, if they can catch it early, you're not even rated. So you can have cancer and buy life insurance if you catch it early enough. So these are technology that's going on. So I want to share with you some things that is going on just so you guys can know. And so the first thing that we're watching is cryptocurrency. And I watch on my phone, I spend $100 on buying Bitcoin. And as of yesterday, I looked at it, I'm at $255. So I've more than doubled my money from my $100 investment. I'm doing it not to invest, I'm doing it to watch and monitor and learn this beast, because I don't know much about Bitcoin. It's this ambiguous currency that's on your phone or whatever else, and you can't see it, touch it, feel it. You go buy a hamburger and you pull out a $10 bill and give them cash. You can see that. But cryptocurrency is something you can't touch it and feel it. But what's happening is the U.S. Treasury is really pushing for this, because two things that are just killing our financial system. One are checks. Who writes checks still? Most of you, yeah. They hate you. Because it's so onerous. But have you noticed, even in our office, one of the technological things, you bring a check in, we used to have to process it, scan it, put it in our system, and run down to the UPS box and ship it. We had to. This is just a couple of years ago we had to do that. And FedEx, it cost us $15 every time, ship it over to San Diego, and they would process the check. Now you bring a check in, Shannon just takes it, sticks it on this machine, and on my computer within 10 minutes it shows up that we can invest that money that fast. And so that's just technology. So the Treasury Department wants to get rid of checks and cash. So their biggest target is checks. Checks are easier to get rid of. So pretty soon you're going to see that, this is talking to Allison Felix from the Treasury Department. She said pretty soon you go to a bank to cash a check, and you want the check, they'll give you basically like a gift card, but it's basically a card with money on it, and they'll just hand you the card, and that will be it. They're not going to hand you the cash. and that's going to be happening pretty soon. But they're trying to eliminate check writing, and they're trying to eliminate cash, and it's going to be happening slowly. It's starting to happen more and more and more. And so eventually we're going to be forced into this cryptocurrency. So that's one of the things that is going on. The second one is autonomous cars. You've heard in the news about that, right? And you have, all these interesting cars in here. The cool thing here is this is an Audi on a racetrack. They've taken this car on a German racetrack and they programmed it, and it drove the track over. This took probably several months of development. It drove the fastest time of anybody in the world. It's faster than the best race car driver now on a racetrack. Now, there's no other cars to race with. It's all by itself, so it's easy. It's not having to think about that. But just the fact that they can get a computer and have this go on the racetrack, figure out where to go, and maximize that motor and braking, it can beat the best driver. So it's happening pretty fast. So, we have all these car manufacturers, Ford, GM, and all these manufacturers here out making cars. And you're like, and autonomous too. We bought a Toyota Highlander for Janet, and that car, I love going to Uray because I go to Uray and I just push this button. I just sit back and it keeps the speed. If you get off track, it beeps, so you don't have to really watch the road a whole lot because it tells you if you're getting off. It'll follow the traffic. And besides turning the steering wheel, it kind of drives itself, and it's called a level 3 self-driving car. That's what ours is a level 3. Level 5 is where it fully drives itself, and that's going to be a little ways down the road, but it's coming pretty quick. And so we have all these manufacturers here that are working hard, spending billions of dollars. I was just telling Fred yesterday or Tuesday, that Mercedes makes the inventor of the internal combustion engine. They've spent billions of dollars in developing the engines, and they announced in this fall that they have stopped all development for the internal combustion gas and diesel engine. It's all going to electric because they said we can't make the engine any better, more efficient from what we know today. Maybe going down the road, they can, with new technology, they can go back and develop something better. But they said today there's diminishing returns. You can't get any better. So that's that. But have you heard of other car makers like Waymo? Waymo is in Vegas, driving around. They'll pull up and drive without a driver in there. Waymo was owned by Google. Google started it, and now Waymo. You ever heard of Yandex? You ever heard of Aurora? You ever heard of Argo? Aptiv? Cruise? There's all these car makers we've never even heard of. So we joke about are you a Ford man or Chevy man? Pretty soon we're going to be fighting over are you a Aurora or Yandex guy? Whatever. These are car makers, and these makers here are so advanced, and they're going to be coming out because driving semi-trucks and hiring drivers on the road and the safety and everything, it's something that's going to happen very fast. So be aware of that. Watch what's going on. And other things that's going to happen. What happens? We have 235 million cars. When we start to get these cars driving for ourselves, we probably couldn't afford it because they're pretty expensive. And what do you need a car sitting in your garage? Your car sits in your garage for 98% of the time anyway. Why pay all that money for it? So pretty soon it's just going to be a drive share. You'll pick up your phone or go on a computer and say, I want a car, and it will come on up, and you'll just tell the car where you want to go, and it will drive. So we will not have need for garages, parking lots, or car dealers in not the too far distant future. So things are going to be changing and all this type of stuff. So what are we going to do with all these houses with garages if we don't have cars? We're going to, I think a new industry will be happening. It's not going to be immediate. It's going to be 10, 20 years down the road. But I bet people will take those garages, convert them over to more living space or something else creative. I don't know what they're going to do with them. And then the things what we don't have is porticos. So you can pull a place for a car to pull up if it's raining, so you can hop in the car and then it will drive on. So we don't have porticos, but we have garages. Well, maybe things will change in that whole industry there. Okay. Oh, and Zooks. I forgot the Zooks. Yeah. So artificial intelligence. It's just amazing stuff that's going on with artificial intelligence, where it can read the news and buy stocks. So what happens? We have all this hyper trading going on. It reads the news articles, and then it deciphers what stock does this affect, and do we buy it? And it figures this out in a split second, and it goes off and buys it automatically, or sells it on the news. And it also writes articles. A lot of your articles that you're seeing on the internet nowadays from companies like USA Today and CNN and CNBC and so on that are written by computers now. They're getting so good at writing. They can pick up the news and write an article. And there's videos, I just don't want to bore you with them, but there's videos that you can read both the articles, and I cannot tell what's written by a human and what's written by a computer. It's amazing. And then also nanotechnology is the other thing. You know what nanotechnology is? It's so tiny. A DNA is 2 nanometers big. And it's, 100,000 times smaller than a human hair. It is so, so tiny. And there's all this technology that's going on that I don't want to bore you with, but it's just amazing. Things are just moving at light speed here. Next one is robotics here. We have, all the jobs that they used to be elbow to elbow with cars going down. Now it's just elbow to elbow with robots. And where's the human being in this picture? I don't know where it is. They're just computers and robots who are taking over. This is like a dog. I forgot his name. Big Dog, I think is his name. And he can walk around, and you can push him over, and he'll stand right back up. And here's a robot that acts kind of like a human. You can tell it's certainly a robot, but it's amazing. She can talk like a human and interact and answer questions like that. And there's just all this technology going on. In medicine, you see it now. A lot of you are the results of many things going on. New medicines, they're getting into all sorts of developments where they can take your genome, and actually make a special drug just for you. If you have a certain disease, they can make that. That's amazing how it is. Biotechnology, stem cells, and just remember, DNA is basically like software. They can actually go in and reprogram DNA and change it for you. So, and nanorobotics, where you're taking pills and it's going in and fixing things. So it's just amazing what is working on and new stuff. I mean, people with cancer, when I was a kid, people get cancer, it's pretty much a death sentence. And now you have a pretty good sporting chance to survive. Okay, energy. You have all kinds of stuff. Oil and gas. You look at this, it's like, why did I put this up there? New technology. Oil and gas really, and that's not the right kind of, but I love the picture of it. But oil and gas is really a technology play. It's amazing that they can actually drill 7 miles down and then have it turn and snake through and find the oil 5 miles over. So you only have one well for a long period of time. If you look at the old pictures in Houston or in Texas, there'd be oil wells every 50 feet or so. You don't need that now. You just need one, and it can go and it will find the oil, and they know how to pull it out and extract it. That's a technology play there. But all the other things going on, nuclear and so on like that, waste and energy, it's also technology. And then finally, what's this all mean to you? Hopefully, now there's the bad side. Let's talk about the bad side first. Bad side is there's all kinds of weird stuff that, they could be creating a superhuman, they could be creating all kinds of bad weapons and so on, all kinds of negative stuff. But let's look at the positive side. What it really does is helps our quality of life, really. Years ago, when they invented the dishwasher, the housewife isn't there washing the dishes. She can throw them in there, push a button, and leave. That is a huge change. And washing machines and so on. It just, huge technology. We don't even think of that as technology, but it sure was back many years ago, wasn't it? It just saved our lives. And look how much more free time we have. And we even have more free time. So hopefully that all this technology will make us happier and relaxed and more content with what we're doing in life. So I just wanted to share you with some of those things on the investment side, and we're watching for those and see if any of that is profitable. Just because a company is a new technology doesn't mean that's something we invest in. And that's what's happened with hemp is all this, they're producing it and making it, but there's nobody making a profit yet. They aren't making a profit, and that's a lot different compared to just selling hemp in stores and getting it out. They got to be making a profit, and that's the key thing. So I want to thank you for coming. Don't forget. So each of you get a little man there at your table. Don't forget to bring him home. I'd like you to take the evaluation and please, there we go. Yeah, please complete the evaluation for Shannon. Give us your opinion. If you'd like to come in and talk to us, we'll be glad to schedule a time. Write that down, and thank you for coming.